If you believe that a stable economy is a safe economy, you have already accepted the lie that precedes every disaster. According to the brilliant, often overlooked economist Hyman Minsky, financial stability is not the absence of risk. It is, in fact, the greatest creator of risk. Minsky's entire thesis, the financial instability hypothesis, argues that periods of prolonged economic calm and growth inevitably lead to complacency, which breeds excessive risk-taking, which then, with cold mathematical certainty, guarantees a catastrophic credit collapse. Minsky wasn't interested in why markets fail. He was interested in how stability forces them to fail. And once you understand his framework, you will be able to look at the global credit market and predict, almost to the day, when the next financial bubble will burst. Today, we are decoding the Minsky Moment, the only true indicator that guarantees a collapse. Minsky breaks down the life cycle of debt into 3 distinct, progressive stages. Think of it as a spectrum of sanity, slowly descending into madness. The first stage, the foundation of any healthy market, is hedge finance. In this stage, borrowers are conservative, responsible, and most importantly, solvent. Their cash flow, the income they generate, is more than sufficient to cover both the interest payments and the principal repayment of their loans. These are the homeowners who have a down payment and steady jobs, the corporations with strong balance sheets and guaranteed revenue. This is a robust system where loans are backed by hard assets and verifiable income. Banks love this stage, and for a long time the system operates smoothly, earning steady profits. But this stability, this predictable success, creates the poison. As profits accumulate and market volatility remains low, financiers, seeking higher returns, begin to take greater risks. They look for borrowers who are a little less solvent, a little more adventurous. This transition pushes the market into speculative finance. In this stage, the borrower's cash flow is sufficient only to cover the interest payments on the debt. They cannot afford to repay the principal. Instead, they bet on the future. They rely on rolling over the debt, taking out a new loan when the old one expires, or they bet that the value of the asset they purchased, be it real estate or stocks, will appreciate enough by maturity to cover the principal. This is the realm of pure speculation, where liquidity is vital and the entire structure hinges on asset prices continuing their upward trajectory. If prices drop or if credit tightens, these borrowers are instantly underwater. The final terrifying stage is Ponzi Finance. This is the terminal illness of the credit cycle. In Ponzi Finance, the borrower's cash flow is not even sufficient to cover the interest payments on the debt. They must borrow more money just to pay the interest on their existing debt. They are not speculating on future asset appreciation. They are speculating on their ability to secure even larger loans in the future. The debt mountain grows not because of profitable activity, but because of the desperate need to service the debt already accrued. This isn't a business model. It is a chain letter where the last borrower into the system pays for the interest of the first. When a significant portion of the total market debt, be it corporate, consumer, or sovereign, shifts into this Ponzi category, the entire system is set on a hair trigger. The Minsky moment is the inevitable trigger event that occurs when the system is saturated with speculative and Ponzi finance. It can be something small, a modest rise in interest rates, a minor dip in the stock market, or a failed bond auction. But because so many participants rely on rolling over their loans, even a small increase in the cost of borrowing forces Ponzi borrowers to default. To cover losses, banks and other market players are forced to sell assets, which pushes asset prices lower. This price drop instantly renders speculative borrowers insolvent, forcing them to sell assets. The cascade is irreversible. Asset sales drive prices down, which forces more sales, creating a self-fulfilling prophecy of collapse. Minsky's genius was showing that the instability wasn't external. It was baked into the cake during the long, calm years of hedge finance. We saw a perfect Minsky moment in 2008. After years of calm, banks shifted mortgage debt from hedge, prime borrowers, to speculative, subprime borrowers who relied on rising home prices, and finally to Ponzi, where lenders offered loans like teaser rate mortgages that required the borrower to roll over into a higher payment loan later, knowing full well the initial cash flows couldn't cover the future interest. When housing prices slightly declined, the Ponzi borrowers defaulted, triggering mass asset sales, which wiped out the speculative debt, collapsing the global financial architecture. Today we see this pattern not in housing, but potentially in corporate debt, where zombie companies exist solely by borrowing to pay interest. Recognizing the Minsky moment is the key to timing your exit from over-leveraged markets. It allows you to anticipate the systemic shock rather than just reacting to the headlines. Understanding this framework is not just about finance. It's about recognizing the psychological inevitability of human greed within a cycle of debt. If this analysis helps you cut through the noise and decode the mechanisms that determine your financial future, please take a moment to subscribe. Subscribing is the best way to ensure you receive the actionable intelligence needed to survive the next crisis before the majority of the market even sees it coming. Next time, we will leave theory behind and apply Minsky's framework directly to the modern era, focusing on the greatest debt machine ever devised. We will explore public versus private debt. Which one will trigger the next global recession? I'll analyze the silent danger lurking in corporate balance sheets versus the loud noise of government debt. Don't miss it.